We've got two views right here, so we want to start looking with Paul Dietrich. He's a director of global research at Washington Wealth Management. We also have Todd back with us for the whole hour of land cult trading, still with us through the close here on Street Smart. Peter, I want to kick it off with you. Forgive me, Paul, I want to kick it off with you. I mean, you can invest anywhere in the world with your fund. What excites you the most these days?
Well, I'll tell you, when you see Japan flatlining, you see Europe in recession, and you see relatively modest growth here in the United States, if you look around the world for the growth, it's in Asia and emerging markets. And that's where we're looking right now. And we're very, very excited with the opportunities. The stock markets in those countries last year did worse than the S&P did here in the United States. They were completely oversold, and now they're still undervalued, and they're going back up. And I think that's where the real buys are.
All right, Todd, I got to say, I'm a little confused by this because Paul's saying, you got a slowdown happening here and in Europe. Thus, he is looking to emerging markets and to Asia for growth. I mean, hey, don't emerging markets depend on us for their very growth? I mean, can we say that they've decoupled enough that they're not going to depend on us in order to grow?
Well, they depend on us as well as China as well. So when you start thinking of the slowdown that's taking place over there, that will impact emerging markets ultimately. I think Paul's right, though. He is saying that there is growth that's taking place in China. He's absolutely right. But a 7.5% growth rate for a former underdeveloped country, it should be an economic powerhouse right now. We should be seeing well north into double digits, and we're not seeing that. So the cause for concern for me is when you start looking at emerging markets, you need to see some type of growth taking place in China to be that octane for that region.
Hey, wait a minute, Todd. What about India? We're always talking about China, but, India's growing at about 14.5%. Their stock market's up 17%. Why aren't we talking about India?
You're right, but China is such a large economy right now. I mean, you think of the Eurozone. They are China's #1 consumer right now. So if the debt bombs that really come into fruition, we start thinking about any type of debt that has to be erased, that will impact China's growth. If that impacts China's growth, that's going to impact emerging markets. That's what makes the United States really probably the best-looking girl at the dance right now.
All right, Paul. Well, I mean, let's ask that point to you. I mean, we're looking at a slowdown in the U.S. We're looking at a slowdown in China. And you know what? Let me qualify that because not really a slowdown in the U.S. In fact, things are actually looking kind of good here. We'll see how robust it all turns out to be. But, Paul, things aren't looking so great in China. I mean, does Todd have a point? You don't want to be investing in an economy that's dependent on China or the U.S.
I disagree. I don't think that the slowdown in China is caused because of Europe or the United States or Japan. People forget that over the last 18 months to 2 years, central banks in China and emerging markets have done everything they could in order to tamp down growth from what they consider unsustainable growth in the 10-12%. And it's been the stated policy of the central bank in China to actually go down to 7-8%. That's their target. So what we can say is they've been successful. This is what they want. And I believe that 7-8%, 6 to 9% in Asia and emerging markets.
Yeah, but you got to look at valuations,
fact,
Paul. Paul, what about valuations? Or let me throw this one at Todd. I mean, when you look at how expensive stocks are in China right now, do they support 7% growth, or were investors betting on much higher growth?
We are looking at much higher growth, Trish. Look, if you take Shanghai out of the equation, they're growing at 10% alone. You take that out of the equation, you're looking at 5% growth for China. 5% for a former underdeveloped country doesn't make a lot of sense right now, and that will have a ripple effect, a trickle-down effect that's negative for emerging markets, for Europe, and possibly even for us here in the U.S.
Okay, so you say the U.S., prettiest girl at the dance right now. What are you buying? Who are you taking out in the U.S.?
I still like the companies that have a global spaghetti string approach. I mean, McDonald's is a great example. You still have Europe that's a big position player for McDonald's as far as revenue. And I think you've got to look at Coca-Cola as well. Some of the staples that we have in this country are also the rest of the global world is dependent upon.
But, Todd, as I listen to you and I hear what you're saying, it's almost like you're having it both ways. You're buying, and maybe that's
exactly.
the point,
Yeah.
Right? Because you're buying U.S. stocks, but you're also keying off U.S. stocks that have foreign exposure. So is the argument really pure? I mean, are you sort of talking out of both sides of your mouth?
Well, sort of there, Adam. But what you really want to look for are companies that actually have some type of global presence. I mean, McDonald's alone, 40% of their revenues come out of Europe. So when you saw the clues 2 weeks ago out of what McDonald's said was that slowdown in Europe was actually impacting their revenue growth for this quarter, that will continue. However, you still need companies that still have those relationships around the globe. You can't just be dependent upon the United States, because if we do fall backwards, that will impact earnings and therefore stock valuation.
Okay, Paul, what are you looking at these days? I mean, do you agree with anything that Todd said? Do you like some of those multinationals?
Yes, I do. I think he's absolutely right. I love the multinationals. However, I do disagree with him. We are going to see 7.5% to 8% growth in China, and China's economic policies are starting to change, and investors make a mistake to ignore Chinese economic policies, and they're moving toward a consumer-oriented society. I believe that will take up a lot of the products being made by their export manufacturers, and so I see consumers in China as the play, and I want to be in the two proxy stocks that represent Chinese consumer growth. I think it's China Mobile and it's CNOOC, their big oil company.
All right, we're going to leave it there. Paul Dietrich of Washington Wealth Management, Todd Schoenberger, Land Cult Trading, thank you so much. Here's the cheat sheet for you if you're just joining us. Paul said he likes emerging markets, especially after the bad performance they had last year. They seem poised for some gains this year. He sees the Chinese consumer really breaking out, so companies like China Mobile and CNOOC. Todd thinks the U.S. is the prettiest girl at the dance.
The prettiest girl at the dance.
I gotta say,
better that he said that than me.
Better that I said that than you?
Better that both of you said that because I would get raked over the coals for saying that sort of thing.
But he did like McDonald's and Coca-Cola and his